Good afternoon, guys. Our next session here is on liquidity stress testing. Our speakers for today include Paul Trinh, Arun Musinipally, and Raman Mandapaka. So, gentlemen, thank you for speaking today, and I will hand it over to Paul.
Arun gets first.
Arun, okay. I'll
Hey,
say.
hey guys, it's been a great day listening to folks from model risk and different disciplines all over the world. It's this is my third year or fourth year joining these sessions, and I learn a lot from these sessions. It's just amazing to see how people from different corners of the world are thinking about model risk and how certain aspects of certain techniques of models can be incorporated into our day-to-day model risk mundane work, I would say. Um, I I've been in insurance risk and model development, and model uh, governance, and finally into model risk from past 26 years. I'm a managing director at Centennial Bank, and I want to introduce Paul real quick, and then I'll come back to my topic. Paul?
I'm Paul Trinh. I'm at Maris Bank. I've been in model risk for about 10 years. I was in market risk management for a while, data risk. I've done a handful of hats throughout my career, but I'm glad to be here. This is my second year to participate in the MRMIA online session, so I'm glad to be here.
Thank you, Paul. I think you already heard from Raman, so let me start the presentation. Raman, can you go to slide one, please, or two? Yeah, liquidity risk beyond rate shocks. How important is liquidity risk? As bankers, and especially in model risk, we know credit risk is very real and very well understood in the banks through CCAR, to DFAST, and different interactions with regulators. You know how important credit history is, the ability to pay, the capital scenarios, the collateral conditions, and economic conditions. All these have been modeled to death, and we've seen a bunch of different models, different approaches. But when it comes to liquidity risk, we don't see that much improvement or advancement apart from just a sensitivity analysis and rate shocks. So today we wanted to provide a little bit more context and see how we can advance our thinking in this area. As you see on the slide, a couple of things that I want to start out with. How important is liquidity risk? For example, the recent events that we've seen with SVB Bank and Signature Bank that failed, and they squarely failed due to liquidity risk. While credit risk is very well managed in the bank, liquidity risk can lead to a death nail. If you didn't manage properly and it's not governed properly, you could be bankrupt real quick. Let's see a couple of facts that happened through the slide. SVB Bank was the 16th largest bank that failed in the U.S. Um, it was also one of the largest tech bank to fail, and you'll see that as I put the bullet points, I'm trying to say on the right side of it as a flag. This is the first flag that I would like to bring to attention. It's the largest tech bank to fail. SVB Bank deposits tripled in about an year and a half to almost $189 billion. And nobody saw this increase or sudden rapid increase as negative. Everybody said this is great. We are doing a good job. Again, red flag number two: deposits rose too quickly. With this excess of deposits, SVB Bank decided, oh, we will take the $100 billion out of the 189 and invest in long-term treasuries. Now, long-term treasuries is deemed as a very safe investment, and it's government backed, so there could be not much risk in there. However, now we know it's too large of a investment in one particular area is not divested. SVB Bank portfolio increased almost $100 billion in a single year. Again, nobody seems to realize that Then comes the deregulation. For all the banks under $250 billion, the regulatory environment relaxed. Now the interest rates increase, leading to a decrease in the bond values. As we know, the value of the bonds was $17 billion less than what they had bought just a year ago. This is another red flag number four. Sharp decline in investment portfolio. So their management meets, model risk and other ERC and other governing bodies meet about it, but they overrule model risk. Due to this, the deposits trend shows sharp decline, about $30 billion in 8 months. This is another red flag. If we had some kind of a mechanism to see these sharp increases and declines, we would have been in a better spot if in SVB as a bank management. Now, because of this, SVB sold a large portion of securities through a regulatory filing on March 8, 2023, at a loss of $1.8 billion. Again, another red flag number six. Now, this gets out in the public because it's a filing, and because, as you know, this is a savvy or tech heavy bank, people start texting each other. Oh, if I were you, I would get my deposit from that bank, and rumor starts going. Next thing you know, this leads to panic. The panic leads to $42 billion being withdrawn on a single day. On Wednesday, again, red flag number seven. By Friday, within 3 days, the Fed seized the bank. So by March 10, 2023, SVB Bank is no more. So what we're trying to say through these points is to say that if we can turn these red flags into some kind of a scenario-based analysis, idiosyncratic scenarios could be one way to tackle these. And I think each bank is going to be different on what their red flags could be because of their concentration in consumer or commercial or more into agricultural risk or their portfolio. So the key is to identify your own red flags for your bank and then move from there. I'll pass this on to Paul. Paul, if you want to take to the next slide on.
Yeah, you bet. Thank you, Arun. So along those lines, as we're testing liquidity stress test models, those are absolutely some of those red flags are the things that we would look at. For example, I think the primary thing that got SVB obviously was their reliance on long-term or their investment in long-term securities did not match their short-term deposits. And so when the long-term securities declined, the short-term deposits started running off, they were in trouble. And there was functionally no way for them to get that back. But these are some other things we need to look at is concentration risk, governance of the liquidity stress test process. We got to look at ALCO, ERC committees to make sure that those groups are doing what they should do. And I would actually lay most of the blame of SVB on those guys, the treasurer and the CFO, the management of the company. Along those lines, how should liquidity be stressed? This is where we have to get into the scenarios. And as Arun mentioned, most of these red flags that we saw on the previous slide are idiosyncratic. But what would it actually take to break the bank? And that's usually one of the few scenarios that most liquidity stress tests have to have. I've seen large banks with 3 scenarios. I've seen small banks with 5 stress scenarios. It depends on the bank. But all of those flags, we should have, at least in your liquidity stress testing, examples of something about concentration risk, deposit surges, obviously investment portfolio decline and sales, and obviously a final run on the bank for short-term deposits. So these are all things that we should absolutely look for when we work on model validations for liquidity stress testing. And I think Raman has a few more stats on the next slide that should be interesting for us. You're on mute.
Thanks, Bob. So I think you and Arun bring up a very important point. Specifically, that liquidity risk stress testing is important. So now the question is, how do you? Most of the time, this is monitored through some sort of a a model or a tool, whatever you may want to call it. I think after this slide, I'll let Arun and Paul debate a bit on that aspect as well, because that's very important, we think. So based on our industry insights, right? So if we look at across the client base, what we see this type of monitoring mechanism is through an Excel based approach, right? So whether we want to call it a model or not, that's different, but some Excel based approach. And remaining 30% use their ALM vendor tool or vendor model to do this, whether it's a QRM or Empyrean or Profit Star, whatever that may be, right? So there are a bunch of ALM third-party vendor models that also provide capabilities to monitor or conduct liquidity risk stress testing. So key point is majority are Excel based approaches where ALM output is flushed into some Excel framework with a bunch of analysis and scenarios, etc. Then the question becomes also how do you, because this is such an important model or a tool, you need to continuously validate it or somehow monitor it, right? So from a governance standpoint, this becomes a very important tool or model. But as we go through these our industry or client space, we see that 40% of the client base ranks these things as low risk. I say these elements because I still don't know whether Paul wants to probably call it a non-model, and Arun probably wants to call it a model. But in any case, they are low risk at 40% of the time. 40% of the time, they are medium risk, but only in a few instances, these are high risk, considered high risk. So that itself has implications for how you want to monitor, right? At the banks, high risk is probably more frequently validated than a low risk model. So oftentimes you may end up not monitoring these elements. Uh, so some of the institutions don't even consider this model. As I said, it's oftentimes termed as EUC or end user computing. Then the question is, okay, oh, oftentimes when we look at the industry, the first thing, oh, it's very simple, right? So this is a very simple mechanism because it's mostly Excel spreadsheet. So but we do see that these are all those spreadsheets, they do have a lot of complexities only because it's not using some sort of a estimation approach or something. It becomes less complex is something that I think one should debate and think about, because the key assumptions that are flushed into these Excel frameworks are not properly documented or even properly assessed in terms of how they are built and so on and so forth. So the automations also within the spreadsheets, because there is some sort of a scenario stress testing that goes on. You can have these type of VBA type frameworks, etc., which can sometimes make this spreadsheet slightly complex, mechanically speaking. On top of that, I think, as I mentioned, a lot of these elements, whether they are mostly the 70% of the Excel spreadsheets, sometimes vendor model modules, liquidity risk stress testing modules are slightly well documented, but oftentimes we find these are not very well documented. When I say they are not very well documented, I don't mean describing each cell in a spreadsheet or how the uh, behind the scenes the code works in a vendor model. It's more as to how the assumptions are built, what is the rationale, how many scenarios are being tested, are there any idiosyncratic scenarios, etc. There's very little thought that goes into documenting this. So overall, I think while as I hear from Paul and Arun that these are interesting elements, these models or spreadsheets, but they seem to have a little less in terms of the governance aspects. So based on that, Paul and Arun, I will put it back to you guys to what are your thoughts in terms of what these are and how do you govern them?
Well, I think we can both absolutely agree on the first bullet point that a strong MRM culture is absolutely essential in having effective challenge. The second one, I think we'd like to debate. I personally think that depending on the complexity of your liquidity stress test process, it may in fact be an EUC, just a spreadsheet with some basic inputs and assumptions, and not a very complicated analytical process. But it also may be a low model or frankly a high model, but I don't think necessarily liquidity models should be classified as tier one. They're definitely higher risk, but tier one I reserve for the big boys like ALM and CECL.
Yeah, I disagree with you, Paul, but that's why we trying to make these points across, right? So um, the way I see it is mechanics in practice when we actually are looking through model validation and looking at a model to evaluate its riskiness, how risky it is, or what tier it needs to be. Most of the industry uses some kind of a matrix, whether it is complex or is it material, how complex is it, and depending upon that, we reach to a certain tiering or high risk, low risk determination, right? And that's where I mean the problem lies there because when we make this the way we are managing model risk as a model risk program governance or heads, we're looking at, okay, it's a low risk model. We're going to validate it every 3 years or 4 years because it's not that risky. At the same time, because it's not that complex, we're not going to apply the same high risk rigorous validation techniques, whether it's the assumption substantiation or is the justification of your assumptions and what kind of ways you can introduce some scenarios. And another pitfall in these approaches in the modeling that we're currently seeing is, as in the previous slide Raman mentioned about, most of them are Excel based or vendor based. So what we see is the vendor based models restrict the model owners to certain rate shocks and only do few things into the process because it's kind of a canned product. You won't be able to adjust in levels. So you can do 5%, 10% increase in sensitivity, or some cash flow adjustment, or something like some sort of a management prescribed math or accounting process that will do it. But most of the vendors currently that are available to do liquidity models, they don't allow you to do simulations. They don't allow you to simulate adverse scenarios and other things that you could. The red flags we discussed, for example, how can you do a survival horizon scenario, like the number of days a firm can survive a severe liquidity crunch, like we saw in the SPB scenario, example. You cannot do that in regular. I mean, you could develop in Excel, you can add on and all things, but the way we are approaching it, because of the low model risk and low level of tiering, it is not required. And on the validation side, because validators are looking at it as a low risk model, they're not challenging it to say, no, no, no. We've just seen what happened with SVP, a signature bank, and other things. Liquidity scenarios are important. Please go ahead and start adding some scenarios. Every bank is different. Some banks are highly capitalized, some banks are in not. And how do you do that? Like, for example, something like a cash conversion cycle. And this is a measure like how fast a company can convert its investments into inventory back to cash. I mean, they have money sitting in investments, but how can you turn it around quickly and put it back in there? All these analyses are advanced, and as such, I argue that that's why this should be placed in higher risk and tier one because of how we need to govern it, not because it's statistically complex.
Fair enough. I would also contend that liquidity risk is primarily Treasury's oversight, right? So it is something that the treasurer, ALCO, they need to actively manage it on a daily basis. But no, I can see that it is absolutely a very risky and important tool / model for the bank, for sure.
Yeah. So I think we see the discussion back and forth. I mean, I see your perspective as a model owner, model validator, and I can also see what I was talking about. Raman, you bring an important perspective because you see both the model development side and validation side. What's your opinion on this?
Yeah, I think I tend to agree or lean towards these being higher risk elements, right? Especially because of the impact they can have if not properly monitored or governed, right? So, especially when you talk about the scenarios, right? So, very limited scenarios, very standard shocks that are analyzed, and therefore that gives you sometimes a false impression of adequate liquidity based on the models, because at the end of the day, banks rely on these particular models or spreadsheets to conclude the liquidity aspects on conclude on liquidity aspects. So therefore, I think it's very important that these are governed properly. Unfortunately, when you talk about the effective challenge, heightened effective challenge, then somehow we have to find a way to bring them to that tier one type of rating so that they can be monitored properly. I think it's very important from that standpoint that these are tier one for me.
So Raman,
Yeah,
can I ask a question?
go ahead.
So what was laid out here as an example, and we don't always have a lot of examples of when there's a problem with a model that results in a failure of a bank. So we don't have a lot of examples. But here is one, or there's a couple here, where there are these failures. And Arun, you laid out in a very itemized way, here were all the red flags in this specific bank. And as a result of those series of red flags, your argument is really that the materiality here is what would have otherwise warranted that this was a high risk model. Should have been a tier one model, should have been more rigorously reviewed. Now, the augmentation of that modeling process that was used might have been very straightforward, very an Excel based even, where they're just doing these rate shocks. Now, I think the collective proposal here is that to augment the cases where there are high risk liquidity models is to introduce a concept of scenarios to that pre-existing rate shock types of models. What that would mean, though, is that every bank would have their own version of red flags, of which they would need to create their own version of scenarios. They would all be slightly different. Their red flags are going to be slightly different. And in fact, that those red flags may not even reach a level that it is high. It could be not red flags. So I guess the question I'm trying to lead up to is one, has there been any specific resistance to from the regulators or just internally from banks to say we need to gussy up the way we're going about these liquidity stress tests? Is there any resistance? And if there isn't resistance, is the broader recommendation, guys, just do some red flags, do some scenarios that match those red flags and complement your pre-existing liquidity stress? Is that the gist of this?
I think, Tom, even though the regulators are not directly asking those questions, but we could see it. Even on a recent exam, they asked, "Can we see your liquidity model?" That was never usually asked before. Hey, and then in our model validation, also within our bank, we had asked our liquidity model owners to incorporate scenarios, especially bank run scenarios. So if you have 10%, 20%, or 40%, simple ways to say, if those percentages were used to do a bank run, would you survive, and where would you get that? I think the discussions are going to be more like, once you have the expectation from the model, from model risk, to apply those requirements to the model owner to have those assumptions, then at the ALCO and different governance bodies, they'll start discussing strategies. Hey, what happens if you have $80 billion withdrawn one day? What do we do? What are the strategies? You have some planning, you have some strategy, and at least they're discussed. As you saw in SVB, within 3 days it's gone. So there is no time as such.
Yeah.
When it starts and when it's over, you could be just a day or two. You're gone. You're done. So
Very good. Thank you.
I think we are pretty much on time there. I'll leave it back to Raman. Any final conclusions or anything before we get to the next session?
I think yeah, we should probably move to the next session. Just one point there, Tom. I don't think it should be a regulatory driven monitoring. Rather, it should be a business driven monitoring. I think this is an important model, which can lead to some serious issues. So I think these models should have the ability to model those idiosyncratic risks, such as the concentration risk that Arun talked about. Therefore, I think elevating the riskiness of these elements would definitely improve the monitoring process.
Are you suggesting, Raman, that from a model risk perspective, that after reviewing the stress of liquidity, that model risk should consider if the idiosyncratic component is appropriately included in that estimation process?
Correct. And to begin with, you should also, in risk ranking these models, you should just slightly move away from your matrix approach, because these are not complex, should not be high risk.
Very good.
Thank you.
Okay, Raman, Paul, Arun, thank you so much. And we will pass it back to, well, I see Peter. If we're passing it
Tom?
back.
Yes.
Tom? Yeah, go ahead, Joe.
Okay. Yeah, thank you very much for this very interesting panel discussion. And I have now the pleasure to reintroduce Joe. You may ask why, because in addition to serving as president of Murmia, he is also CEO of Deep Future Analytics, the co-sponsor of this event here. And I think Joe would like to share some interesting developments in the monitoring of AI environments. So, Joe, please tell us.
All right. Thank you, Peter. Yes, everyone, I have to put on my other hat for the moment as CEO of Deep Future Analytics. As part of our sponsorship package, I get a few minutes just to show what we're up to. I think relevant for this event is that we have been very much involved in AI risk management and have developed a tool for AI augmented human in the loop so that you can get scalability, consistency, refinement, rapid response, regulatory transparency, a lot of the things that we're talking about that we need with AI. This is a monitoring tool, but we're not letting the AI make the decisions. We're asking it to help us so that the humans can be more effective. So the basic system design is that any type of text communication, messaging, emails, anything that you might be wanting to monitor, we would also design a list with our clients of assertions, basically policy statements, any rules that we want to be true. We run that through a generative AI comparator and we continuously test all the current options out there. We ask that comparator to give us back a green, yellow, red. Are these two consistent? So it's not a judge, it's a language check. Is the message agreeing, consistent with a certain assertion? And as it scans through these many things, the green ones we will archive. The yellow, where it's not sure, or the red, where it's fairly certain it fails, both those go into a dashboard so that the human in the loop task, instead of trying to find one message out of 100 that might fail on one policy out of a dozen or 2 dozen, we narrow that down to a 1 in 5 type problem where the likely failure is highlighted. And as far as what kinds of things go in those assertions, every institution is going to be different. We've been doing this in a lot of different countries, especially across Asia and such, and they definitely depend on where you're located. And with that dashboard, then you can start to gather statistics. And this is an important thing, because the way monitoring has been done has been more complaint investigation as opposed to statistical sampling in order to understand compliance rates by policies. And then individual messages can be brought up to look at and review. And so the ultimate task of the human in the loop reviewer is to pass or fail or escalate the individual messages. And I think one of the most powerful aspects of this is to compare the AI to the human. And I've started to realize that now we have to treat humans as models too. If we're trying to replace certain human tasks with AI tools, the only way to know if the AI is good enough is to know what the performance rates are for the humans. And so that means on policy compliance and all these things, we've never systematically looked at how well human staff performs across the range of policies and monitor that through time. So this allows us to do that comparison between human and AI, or even different versions of AI as the vendor rolls out new versions. So of course, this goes into reporting. And that's what I wanted to cover really quickly. I appreciate my few minutes here to show you what we're doing. If you're interested, please give us a call. Let me know.